Welcome back to my channel, everyone. I thought today we would talk about the current market, mainly the lending market, and also what's going on with interest rates and what impact that is having in real terms to developers, to buyers, and house prices in general. So all it takes is you looking at any news article, any headline on any given day at the minute, and it's all doom and gloom about the economy pretty much. And one of the main focus points is house prices. You'll see headlines like worst drop in house prices since the 2007 or 2008 crash, house prices dropping by 10%. And that's scary to hear, quite frankly, for any sort of normal news reader. But I think one thing that's important to remember when it comes to things like news articles is that is what keeps these newspapers in business, is the scaremongering. Look at what was going around COVID. So always take what we see here with a pinch of salt. And actually, what's the bigger picture? Well, if we look back to house prices, say November 2019 compared to November 2022, we are up nearly 20%. We saw a massive boom in house prices around the COVID time, and it was quite frankly unsustainable. You speak to any decent estate agent, anyone in economics, they will say that that sort of rapid increase in house prices was never going to be sustainable. So what we're currently seeing with this drop of, say, 10%, is that a market crash, as the newspapers are suggesting, or is it simply a correction to what was actually abnormal behaviour for a market in the first place? My opinion is it's actually the latter, and it was much needed. We needed to have this correction in order to stabilise house prices. And even if we end up back at pre-COVID levels, that's not a bad place to be. So what is one of the things that have led to the drop in house prices? Well, I think the interest rates rising has been one of the factors that have contributed to this. During COVID, huge amounts of money were printed to help with the COVID response. And as any person will know, when you print lots of money, you are then at risk of inflation in that marketplace. So one easy way to pull money back out of the market to help try and curb inflation is to rise interest rates. And that's exactly what we've seen. More money's been pulled out of the market, and actually inflation has been being curbed, which is a great thing. Now, overall, it obviously does have negative impacts elsewhere, but one of the key purposes of rising the interest rates has been achieved with the steadying of inflation that we were seeing. So what are the impacts of this on developers? There are impacts for everyone in every sector of the market, every business, every individual. And some of them are good, some of them are bad. We're not here to talk about and thrash out the ins and outs of every good and bad that has come from the rise in interest rates, but we are here to talk about what impact it has on developers. So I think the most real impact that developers are seeing is the reduction in net loan amounts. So when we go to a bank, and most developers will use banks unless you have a massive cash pot, and even so you still don't tend to just use it all yourself, 99.9% of us will use some sort of bank funding. Now, how this works is you typically have a loan to value, which is, let's say, 75%, meaning that they will lend you up to 75% of the total value of that site. So if your GDV is £1 million, you could lend up to £750,000. Now, importantly, this is the gross facility. And from that, as developers receive a net facility, which is minus the cost of finance. Now, obviously, if interest rates go up under the exact same loan to value, we now receive a lower net amount simply because that cost portion has increased because the interest rates have increased. Okay, there is the cost, but that's not necessarily a cost that comes out of our bank account in the sense that we don't pay it, we just don't have access to the interest rates, and it does come off the facility and obviously the profit at the back end. But sort of upfront, true, real cost, what is the impact of the interest rate rise? And it's actually in the equity contribution required by the developers. So what this means is, 75% loan to value, it might represent, let's say, 85% of your costs, which means you're needing to find 15% of them. If your net facility reduces, the input needed by you as a developer increases because that gap has to be filled. Your costs are the same. And what this can often mean is that quite last minute, usually, the developer needs to find, it's not normally £50,000, it's normally a couple of £100,000, or, a lot of people are having to find over £1 million of equity all of a sudden in a deal to compensate for the shortfall in the net loan amounts. Now, unless you're a developer that's experienced in raising equity or raising, let's say, a second charge debt from private investors, or perhaps you're comfortable with a mezzanine facility, this leaves you with some sort of deficit. And the true impact of that, and what we're now starting to see trickle through, and I think we'll see a lot more of in the new year, is a lot of developers are having to sell on at least one of their sites. So most developers will have several deals at different stages in deal cycles at any given moment. So they might have one completing, one starting, one halfway through construction, and maybe 2 or 3 in planning, with the view that maybe one won't get approved and the other 2 will form part of their eventual deal pipeline. What we're now seeing is that of those, let's say, 3 deals that they're taking through planning, they're having to maybe offload one of them, take the planning gain, the profit in the land, take that out at that early stage because they've sold it on to another developer, in order to release equity, essentially, in order to put into their other deals and keep their other deals moving forward. So what this means is we're going to see a lot of oven-ready sites come into the market. Sites that had every intention of being built out by that developer, but circumstances have changed, the lending market's changed, their lending has changed, and therefore they're having to offload these excellent opportunities. One thing we are also seeing, and it's not necessarily linked to the interest rates, is there is, I suppose, off the back of the sentiment in the market, a little bit of uncertainty, a little bit of nervousness around house prices, we are seeing the start of some down valuations on sites. And what this means is that's affecting your day one loan to value. And that's where everything starts pretty much. So if you're expecting your site to value up at £10 million, you're then working your loan to values back from that top line value, which is 10 million. Let's say you got 75% loan to value. So day one, before we even talk about what's happening with the net loans, we're assuming a £7.5 million loan facility. If, of course, the valuer, whoever, down values your site to, let's say, 8 million, and you're now only getting 75% of that 8 million, your gross loan is already reduced from where your expectations were. So even if the interest rates stayed exactly the same, you would be in a worse off situation. And actually, we're probably going to start seeing a combination of the 2 of these things happening. One, interest rates rising, reducing net loans, and gross loans starting from a lower position because of down valuations from our valuers. And again, this just leads into the fact that many developers are going to be in an equity shortfall in their deals, and therefore going to have to offload some into the market in order to release equity for other deals that they've got going on, which does present amazing opportunity for some people as well. Now, what impact does the rise in interest rates have on our buyers, our home buyers, first-time buyers, everyone? Well, the simple thing is you can't afford as much. So when you go for a mortgage, you are quite stringently tested for affordability. So your income is £45,000 a year, and they will say, you know, based off of what you take home after tax, you can afford X on a mortgage. And this is linked into the fact that, you know, you might be entering into a 3-year fixed term at a low interest rate, which is what we've seen over the last 10 years. So therefore they say, oh, you can borrow, Rosie, you're allowed to borrow £250,000 off the back of that. And you go, brilliant, thank you. I'm going to add that to my deposit. And I'm looking at homes worth, let's say, £300,000. Fantastic. So what this interest rate rise means is that the average buyer now just can't afford as much property as they could before. So as more of their monthly payment has been made up with interest, let's say they had, they could at maximum afford £1,000 a month repayment. Now with the higher interest rates, that actually results in a lower mortgage amount because there's more interest in it. And what that does is it pushes more buyers into the lower end of the market. So, people that were looking at £300,000 properties a year ago may now only be able to afford something in the £250,000 sort of bracket, which creates more competition at the entry level points of the market. It pushes some buyers out of the market entirely. Some first-time buyers may have to wait another year or 2 in order to be able to bump up their deposits in order to afford more. And it results in less competition in the top end of the market. And this is actually where we normally see the biggest hit in house prices. And it's simply because there's less buyers, less competition. It becomes a buyer's market, not a seller's market. Whenever you're selling, you want as many people bidding on that product as possible to bump up the price. When something like what we're seeing happens at the minute and buyers are driven downward in the market, Simply, there's not as many buyers, not as many competitions, and it works in the buyer's favour, and they can buy those properties cheaper than they could have, say, 12 months ago. For developers, this is typically an indicator that you would want to be focusing on what we always class as our more liquid sites. So the smaller sites of smaller units that have more buyers for them, sell quicker, built quicker, sort of more in and out type jobs. It's not necessarily the best market to be looking at for ultra luxury, because most likely we're going to see the biggest hit in house prices there, and banks will also be more cautious about lending on sites of, say, 5 big detached homes versus at the upper quartile of the price point in that market, versus lending on 20 sort of starter to mid-level point homes in the same, let's say, location, simply because that site of more smaller units will be considered more liquid, more buyers, more robust going into a downward cycle than something at the upper quartile of that market would be. Now, this all seems super negative, really, but actually, where are the opportunities? Now, fundamentally, one thing that we at Newman Rose believe is that there is always an abundance of opportunity, and not only that, it's a level playing field. Everyone is dealing with the same market. It's not a market situation that's only affecting me. It's not interest rate rises that are only affecting me. It's affecting me and every other developer out there. So really, we're all going through the same market cycle, which means there's still not everyone downs tools. No one stops making money completely. So where are those opportunities? I think at the minute, as I mentioned, there is amazing opportunity for buying pretty oven-ready sites. And this is great simply because since COVID, planning has been getting worse and worse and harder for developers. It's taking unbelievably long to get anything approved. For example, we have a landscape reserve matters, which is a pretty simple matter to get approved. It's been going on for over 6 months to get that simple reserve matter approved, which should never be the case, but unfortunately is, just given the way that the planners are working at the minute. So being able to buy oven-ready sites that someone else has taken through planning is a great opportunity to not have to go through that headache, and also the risk of unexpected delays with planning that are quite frankly out of your control. I also think, and this might be a little bit controversial of an opinion, this is a great opportunity for first-time developers to get into the market, particularly if you are someone that has capital already or has access to the capital, but you don't have the experience in order to satisfy a bank, or perhaps to feel confident enough to go it alone. You have these developers that are looking to potentially offload sites to release equity, but what if you presented the opportunity to them to bring in the equity requirement, but actually do it on a joint venture basis? What that would allow you to do in terms of looking at it from the bank's perspective is you'll be piggybacking off of that developer's experience, which looks favourably for you. You can learn, obviously, throughout that process. You could stipulate, quite early on that part of this joint venture agreement is that you want to shadow them quite closely to learn, obviously, from their expertise. And then if you want in the future, you could look to go on your own, having now delivered a project, got the experience yourself for the bank's perspective, but also, internally, that you now have more experience than going into the first deal. You can obviously take your money back out of that deal and some of the profit to cycle into more deals. And not only that, the bank looks at you having developed a project during what is a more difficult market. So if you can do it and do it successfully when times are tough, things get easier when we're going in an upward market. So let's say you come out of your first deal cycle into your next one and the market's back on the up. That looks favourably for you. If you can do it when times are tough, it gets easier when the sun shines, pretty much. And also for our property investors out there, this is a great opportunity because, as I said, there's a lot of developers who are amazing experience, amazing track records, who simply have just been caught out a little bit with what's going on, who are in need of equity. So there's great opportunity for you to be an investor in a lot of deals that will be going around the market at the minute, which, hopefully will have some amazing returns. So there's definitely opportunity if you know where to look for it. Fundamentally, we still, of course, need to be sticking by appraising things right, working to the right margins, being conservative. It doesn't mean every deal works, and some developers selling land probably will be a little bit overpriced because they think they can build things cheaper than everyone else, kind of things going on. So it doesn't mean that everything's a surefire deal. It just means that there's probably going to be an influx of deals into the market for you to work through, to appraise, to offer on, and to process. And off the back of one of them, you are bound to find some amazing opportunities. So that's a quick wrap up of my thoughts on what's going on with the interest rates and the impacts in the market. Comment below any other videos that you want to see me do. Don't forget to like and subscribe to the channel, and I'll see you guys soon.